Okay, hey, Ryan here for the weekly update. We're going to jump right in, James, this week and talk about this doctor loan program you just sent over to me.
Hey, Ryan, how's it going?
Good, good. So I have it up on the screen. Can you see it?
Yes, I can.
Great. So physician doctor loans. I'm looking here. I'm going to start down here at the bottom and let you explain who qualifies for this program.
Yeah, so it's all doctors related to the list of medical doctors that you see there would qualify for this program. And it actually offers up to 97% financing up to a $650,000 loan, or 90% financing up to an $850,000 loan. So it's very very aggressive as far as leverage is concerned, and it's specific to doctors. There's some reduced bank fees for doctors on these programs as well. And, it does require a little bit of a higher credit score. You can actually, with a 700 credit score, go to 95 LTV up to 650, 720 plus, you can go up to 97%. It's offered with a 5-1, 7-1 LIBOR ARM program. And, the idea behind it is as a doctor, newer doctors, obviously you're working off a lot of those student loans. And so it's a way to provide leverage to the doctor community, with obviously the premise being that your income is going to increase rapidly, right? So you'd be able to manage, obviously you're still going to qualify for the program as is, but you typically have debts that you're paying off, and within the first 5 to 7 years paying back those loans, and whether you're trading up at that point or then looking to refinance at a lower loan to value into something longer term, that's what the program is really catered to.
So the 5-1 and the 7-1, that means that I think most people are familiar, but basically for 5 years they're going to be at a lower rate.
That's right. 5-year, 7-year is typically a lower rate when you're talking adjustable compared to a fixed program.
Right.
And the data shows that most people in the medical profession, this really, where I've seen this work the most is the younger doctor. He or she just starting out either as a medical resident or early in their practice, that typically this isn't going to be their last home, right? It's going to be their first home. It's typically a 5 to 7 year window. And, again, once those student loans are paid off, then they're going to, trade up to the $1 million plus home. And so that's really the tailored thesis behind this program. It's really that first-time home buyer doctor program.
Gotcha. Sorry, I had myself muted out. But first-time buyers, and of course, seasoned doctors, so to speak. People are a little older.
It's not limited to.
Right, they're welcome to it too.
Yeah. Correct. Absolutely.
Great. Okay, so anybody watching this right now, please share this with any doctors you know. This is just doctors, dentists, nurses. Do you have anything for nurses?
Nurses, not specifically. There are some, I think when we talk about nurses, I think qualifying for a mortgage for nurses, we do have some creative ways, especially the per diem nurse. Most nurses today, and when we talk about self-employment, a lot of people in the medical profession do take a 1099 today because of the insurance requirements, and they're able to get paid out a little bit more, and so they choose that option. So as we always talk about, we're here to help the self-employed individual. We do have a lot of programs tailored to them that will help them qualify for mortgage outside of the conventional means. And the one thing about this doctor program too is that the any loan that will be deferred for a minimum of 12 months does not have to be included in the debt to income ratio. So where that used to be allowed on a conventional basis and no longer is, in this program, you can still take those loan payments out of the qualifying ratio.
So a doctor could basically, it would make sense to defer their student loans for a year?
Yeah, or if you just got out of med school and you're in your residency and your student loans are deferred out 2 years from the day that you graduate, on a conventional basis, we have to calculate those payments in. You have to qualify with those payments.
Okay.
For example, I just did a doctor's mortgage. She was in a residency program, just coming out of med school, like 6 months. She had $325,000 in student loans. Her student loan payment was about $2,500 a month. This is a mortgage, but it's deferred till 2019. So we didn't have to count that $2,500 payment in the calculation, in the qualifying of the loan. Otherwise, she wouldn't have qualified because she had six-figure income, low six figures. But obviously, being early on, that obviously that income is going to increase. At least the numbers show. So we can exclude it because by the time she starts paying it back, probably her income will be double or 2.5 times what she's making now.
Got it. Great. So anybody listening to this, if you know any doctors, share this, right? This is a great option. A lot of people don't know that programs like this are out there until you hear it talked about watching a video like this. And James, I'll make sure your info is included somewhere near this video for them to get in touch with you, right? You're handling these? Yeah.
Absolutely, yeah. Reach out to me directly.
Sorry, I didn't know if it was somebody else at the company who was doing doctors specifically, if it was you. Yeah. Okay. And then
myself or someone. But all the advisors are aware of the product. They're all familiar with it. I mean, anyone can help here. But if anybody wants to reach out to me directly with it, that's fine.
Great. Okay. And then we'll jump right in really quick on rates, right? I don't think a lot's changed in the last week, but yeah, you'll tell me.
It has. They are definitely higher than they were a week ago. You had a major sell-off in the Fannie Mae bonds on Friday, and that's kind of continued today. So you're up at least 1/8%. From the end of last, probably midweek last week, we kind of retested some lows. We were in that low 230 range, and I think today we're at 240 on the 10-year bond. So there has been some sell-off. Nothing really specific to go with that other than, again, the world is all one place today. So bonds sold off in Europe. They sold off here. You would have thought with everything going on in the tax relief world that rates would be lower because nothing doesn't seem to be going in the right direction. And the stock market's held on pretty good as well, but a little bit higher, nothing major, but definitely still trending towards the higher end of the range as far as interest rates are concerned. Okay, so around 4% still, but maybe a shade higher than they were a week ago? Absolutely. Yep, probably, you were at that 3.75 level a week or so ago, probably a shade under, 4% with obviously, excellent credit, et cetera. Great. All right. Thanks, James. I'll go ahead and make sure that this recording is posted and that people can easily share this with their doctor friends. And we'll be back next week. All right, Rod. And happy belated Veterans Day. Since we didn't do the update Friday, I wasn't here, but to all the vets out there, please remember, obviously, we're proud of our country and proud of your service, that all veterans pay, they're credited back our lender origination fees, no application, no commitment fee. On a VA loan, that saves you about, $1,400. So thanks again, and happy belated Veterans Day. Great. Yeah, thanks for mentioning that. No origination fees for veterans. So if you know doctors and you know veterans right now, please forward this video to them. Okay. Thanks, James. Veteran doctors. Doctors, yep. All right, have a good one. All right, Ryan. Talk to you soon. Thanks.